So last Friday, remember the market was melting down. One thing I wanted you to look at, and I mentioned the S&P 500 was holding above its 50-day moving average. I think that's bullish, shows that sort of resolve. And now it's still going, by the way, it's still moving. It's 117 days. It's been moving straight up. That's a pretty good streak, but there's another streak happening, right? And that's the fear index, the VIX, the so-called fear index. Now, that's above its 50-day moving average for 14 days. Now, according to Blue Kerchick, both of these indicate potential, a little bit of a potential dip, near-term dip, but a buyable dip, right, on the horizon. So I think it's impressive. It's one of these things like, it's a body in motion stays in motion. So this should give you some calm. Now, of course, overall, you don't want to confuse any of this with all the anxiety and all the chatter about a possible pullback. Now, according to Bank of America, their most recent global fund manager survey, the so-called AI bubble, that's your most persistent, biggest tail risk, right? That's what, below that, second wave of inflation and Fed independence, but really the AI bubble kind of thing keeps talking. But if you look at this table here, the biggest thing to be maybe concerned about is the source of a potential credit event. And we've talked about it on this show for a couple of weeks. Private equity, private credit, still sort of smoldering. The news, nothing new is happening yet, but it's still opaque and worrisome. Now, I happen to think that the biggest bubble of all of them, right, are news articles about bubbles, particularly tech and AI bubbles. Look at that spike. Kind of reminds you in April and May, right, with all those negative things, all the tariff stuff, all the drum beats, they get you worked up, they get you afraid, they get you to sell, and no one says anything when stocks go up after you've been, look, all these headlines can get you scared. Now, if only these same folks were pounding the table before all of these stocks went parabolic. Now, here's the rub. Most people are in the market trying to create wealth. They don't have the luxury of being wrong for long stretches of time. Now, right now, risk and momentum are absolutely crushing it. Now, if you would have played the stuff or avoided that and gone with, let's just say, quality, you'd only be down 10%. Let's face it. I'm being a little, I'm joking around a little bit here, but this is a huge divide, a huge gulf, right? You either made a lot of money this year, you sat it out, or you're losing money. And then there's something else, right? There's this hidden rally in the micro cap stocks. I mean, golly, to put it in perspective, this is micro cap versus small caps. Look at this move. It's just absolutely phenomenal. And the bottom line, I think, really is that for those who are in the market, after making fortunes in areas that the experts told you not to, right? They don't want to get their suits dirty. The bottom line, folks, there's a lot of gold in them hills.
To find nuggets of molten gold. It's rich, but not that rich. And here ain't the place to dig. It comes from someplace further up. Up there. Up there's where we got to go. Up there.
Up yonder, folks, but there's gold in them hills right now. Last week, my next guest posted on the Substack that the market cap finally started to win from the bottom up. Let's bring in Jim Paulsen. And Jim, great chart here. You're showing again, you were ahead of the curve talking about this, but these micro caps really starting to take off here. And it's a monster move, but what do you make of it? How do you interpret this?
Well, I kind of think, that we've had a narrow bull market, the whole bull market. And that, I think, mainly is tied to the fact that the economic policies have been tightening the whole time, Charles. And when you're tightening economic policies, a lot of the lower cap stocks sort of need liquidity. They need lower rates. They need a lower dollar. They need faster monetary growth in order to perform. Generally, they get that earlier in the bull. That's how bulls usually start. But this one didn't. It started with tightening and has lived its entire existence under tightening. What we're seeing different is for the first time, we're seeing the Fed easing. We're seeing interest rates came down a little bit last year and then they paused. Now they're coming down again. The bond yield just today went under 4% on the 10-year yield. We're seeing money supply quickening. The dollar is off 10% this year with all the talk of easing. And that's just medicine for the smaller cap stocks in this country. It's support. And with support, we're seeing them starting to perform. The Russell 2000, I think, is up 9% better than the S&P 500 from the April 8th lows in the stock market.
Right.
And now year to date, it's only off about 1% compared to what the S&P's done.
Right.
And as you mentioned, the microcaps have done even better than that, and the IPOs have done better than microcaps. So we're seeing capitalization respond, I think, more than anything to policy easing. They're also very underowned. Who among us hasn't been disappointed with owning small caps for a long time?
Right.
And they're really relatively good values as well.
So, you know, one of the charts you posted here recently talked about the return of animal spirits, right? They're sort of broadening out. And I keep, I want to see this as well. And I see it every now and then. I see it maybe 2 or 3 sessions in a row, but then we got to revert back to the mean. The market gets in trouble, and the new de facto safe haven is technology and communication services. Are we seeing the kind of broadening out that suggests that this market's getting an extra boost right now?
I think so, and it is as the years gone on, it's getting broader and broader. It was so narrow. If you go back and look at last year or the year before, there was always, like you said, 2 sectors at the top and then nothing else in the S&P 500. If you look at this year to date, most sectors are at least participating in a fairly decent way, and there's a number of sectors, double-digit returns pretty close to the S&P overall. So you still have the tech and communications a lot higher, but you have a lot of sectors which are now pretty close to the overall S&P year-to-date return. And I think that reflects a broader-based sort of participation going on. And I do think it reflects that change in policy. But if you look, too, Charles, at the rest of the market outside of tech and communications, those values are not that bad. The relative PE on the Russell 2000 trailing PE back to 95 is below average over that full period of time. And the mid caps are just about the same. So there's a lot of this stock market, because it hasn't participated, is kind of like the start of a new bull. It's pretty valuable and it's pretty underowned.
Well, it's good to hear you talk about that. I know it wasn't long ago you were still kind of looking for those animal spirits. I got less than a minute to go, but I do want to ask you about this great chart here. You talk about the economic sentiment, now worse than 81% of the time going back to 1980. Every news story is a negative story. Even when the market's up, they make it a negative story because they say, is this too much? They can make the greatest session in the world feel like the end of the world. What does that tell investors?
Well, the interesting thing about that is the economic sentiment is really, really bleak right now. Like I said, it's lowest quintile going back to 1980. And generally, when you have sentiment like this, you're in a recession. And you'd think that'd be bad, but as it turns out, the lower that sentiment index is, and particularly when you have readings in the lowest quintile, you have good forward 1-month average annualized returns. And I think that's because of the contrarian nature of sentiment. When it really gets bleak and everyone thinks we're going down, that's often a good time to buy because most people have already sold and they're waiting for it to happen. And there's a lot of money that could come back in if it keeps going up, and they were wrong. And I think that's the position we're in today. As you say, there's just so much concern about the replaying the dot-com top. Andrew Ross Sorkin came out with the 1929 comparison book this week. Today, Jamie Dimon's out warning about credit risk. And I think that it's all of that in some ways is a good thing because it keeps us on that perpetual wall of worry that's been a big part of this bull market.
Right, and to build on what you were just saying for the audience, if this was irrational exuberance, the markets wouldn't dip on this kind of thing, right? We just keep powering higher and ignore it. The fact that people are really concerned means that they're not irrationally exuberant, which to your point is probably a good thing. Jim, thank you so much. Appreciate it.